He is the founder, editor, and publisher of the Felder Report. And Jesse's been involved in money management 20 years, and he began his career at Bear Stearns and Company. But now he is doing his report, the Felder Report. Glad to have you here, Jesse. What have you got for us? The market's crazy. We need to know what to do.
Yeah, thanks. Thanks, Aaron. No, last time you guys had me on, I went through like my whole chart book and it covered a variety of asset classes. This time I figured I'd dial into the broad stock market a little bit more and just take a look at some of the things I'm looking at. This first chart here is just a weekly chart of the S&P 500. And for at least a year now, I've been calling this kind of a topping process. This looks to me, I think it's pretty easy to probably draw a megaphone or broadening top pattern here right now. But when I look at the other indexes, I think it helps to kind of see what's going on with the broad market aside from just the S&P 500. So we see the S&P since made this high in early 18, made another high last summer before that fourth quarter decline, and this year we've taken out those highs before giving them back, which could prove to be a false breakout. But we look at the NYSE Composite Index. We can see that since that 2018 high, we've essentially only been making lower highs. And to me, this kind of is just a sign that even while the S&P has been powering higher, the broader, under the surface has not been doing that. You also look at the Russell 2000. You can see that we did make this high in early 18. Then last summer we made a new high, but since then, we're down close to 20% on the Russell 2000. And the Dow Transportation Average too is another one. That shows, kind of not the type of strength that we'd want to see at the highs we've made this year. We see, increasing kind of dispersion among the indexes. And really, I don't know how much you guys talked about this, recently, but it's pretty clear, I think, to anybody that there's a Dow theory non-confirmation. The industrials made a new high. Transportation average is not close. And I think, that was originally intended as more of an economic signal than a technical one when it was developed. And so along with the things like the yield curve, which is much more popular for people to talk about, this is a sign of potential economic weakness. And we're seeing that about a number of other things that I'll get to. But this type of dispersion among the indexes really reminds me of the topping process in 2000. And so here are a few charts of the same indexes into that 2000 top. We see the S&P famously peaked in March of 2000 before kind of rolling over to the end of the year. Really, bear market didn't kind of kick off until 2001 when we took out these 2000 lows. But the NYSE Composite actually went on to make a higher high in September of that year, which a lot of people don't remember. Everybody thinks, the NASDAQ blew off in March of 2000. That was it, was done. No, the NYSE Composite went on to make a high later on in the year. Russell 2000 did peak in March and then rolled over pretty hard after that March, kind of similar to the NASDAQ, although it did dramatically underperform the broad markets. And we'll look at that later on too. But really the transportation average was the one that peaked in, almost a year before the rest of the market. The Dow Jones Industrial Average, I think, peaked in January of 2000, but the transports peaked in, was that May of 1999 and had rolled over really hard while the rest of the market kind of went higher. And to me, that was that potential economic warning signal, also a red flag for that growing dispersion across the indexes. And so what contributes to this growing dispersion? It ties into this economic weakness. This is something else that dates back to 2000, and Stan Druckenmiller talked about a year ago, is that he famously was trying to short the NASDAQ in March of 2000. On the day that it peaked, though, he capitulated and covered all of his shorts and went heavily long the NASDAQ right on the peak. And then the market rolled over really hard in that March peak, and he decided to sell all of his longs and try and go short again. And he actually had such a difficult time during that period. He took a hiatus from the markets because he was just not trading trading very well. But he came back in the fall of 2000 up here when the NYSE was making this new high. And he had noticed something, and that was that interest rates had been rising, the oil price had been rising, and the dollar had all been rising together. And typically when you get all three of these things going on like this, it typically leads to a recession and almost always leads to an earnings recession. And so what we've seen over the last couple of years is very similar to what we saw in 2000. We had rising interest rates until very recently. We had, essentially from the election until late last year, we had rising oil prices rebounding after their sell-off. And then we had the strength in the dollar, which everybody, has been paying attention to because, Trump has been so vocal about complaining about the strength in the dollar. And so all three of these things are something that's been going on for a couple of years now. So what are we looking at now? We're looking at an earnings recession again, similar to what we saw during that 2001-2 bear market. So I think this is what markets are beginning to price in, is this type of economic weakness as a result of these macro trends. This chart, a lot of people have been talking about the yield curve. This is a chart. I've inverted the yield curve here and overlaid it with VIX. And when you look at these things, and it's really kind of hard to make sense of this chart, but when you shift the yield curve forward 2 or 3 years, you can see that the yield curve, when it flattens, it begins to forecast rising volatility. And this makes perfect sense to me in terms of how the credit cycle works. You get a flattening yield curve. Banks have no incentive, lenders have no incentive to borrow short and lend long. There's no profit margin in it. There's no net interest margin. And so you get a contraction of credit, which leads to usually a widening of spreads, usually financial stress. Financial stress is very highly correlated with the VIX. And so we should be, entering this period, the yield curve, not only forecasting some economic weakness, it's forecasting some, financial stress over the next few years, which should lead to a rising VIX. This was the case during the last 2 cycles as well. So, we're seeing these signs of, whether it's rising dollar, rising oil, rising interest rates, flattening yield curve. All these signs are kind of macro signs pointing to economic and market weakness in the future. And when you actually dial down into the sector-specific stuff, you can see this. The most cyclically sensitive sectors in the market are the ones that are diverging most dramatically from the indexes. You have, retail here. This is the relative performance of retail to the S&P 500. Transportation average, and metals and mining. You can see all these things kind of weakened through this 2015 and early 2016 period where we had, according to some people, we could have had a recession in that early 2016. We definitely had a manufacturing industrial recession. But again, since last summer, we've had renewed weakness in these economically important sectors. And so that's really what's driving the dispersion underneath the surface. And I think it's even fun to dial down even further and look at something like the gap to Walmart ratio. So if we just look within the retail sector, what's driving the retail weakness? It's not Walmart. Walmart's been doing great lately, but I like to look at this gap to Walmart ratio because it goes back to the 80s. You can look back through several cycles, and you can see when gap is dramatically weak relative to Walmart, that's usually coincides with bear market and recession. You can see, this ratio peaked in mid 99 and sold off pretty hard. It was kind of a decent leading indicator for this topping process for the market in 2000. Same thing in 2008-9, but it's been really more marked, over the last year or so, where you see gap dramatic underperformance relative to Walmart. And to me, this is another one that just makes intuitive sense, where you have, when people are earning good money and the economy is good, they're more likely to go spend money at Gap. When things are not so good, they're more likely to, spend on staples and things, or be kind of more cost conscious and spend money at Walmart. Another similar ratio that I've looked at for a long time is this Dollar Tree to Macy's ratio. We could make it Macy's to Dollar Tree, so it would look similar to this one, but I prefer to look at it almost as like, this reminds me of this chart of the New York Fed's recession probability model. When this thing spikes, that means the probability of recession is getting higher. When people, and it's very similar to this other ratio. When things are good and people are feeling, more willing to spend, they'll probably spend on more higher ticket items at a place like Macy's. When money's tight, they're more likely to focus on something like Dollar Tree. And right now, this ratio is spiking. It did spike, in that 2016 and even into 17. And some of this trend is obviously just the retail apocalypse, right? A lot of these kind of mall-based stocks have generally been doing very poorly. But I think that explains the trend. The spikes themselves, that doesn't necessarily explain the spikes so much. And so the spikes, to me, can be a warning of economic weakness. And so it's these kinds of stocks, the retail names and most specifically the most economically sensitive retail names that are driving the divergences underneath the surface of the indexes. And we can see these divergences when we look at things like, this is the S&P 500, the ratio of the equal weight SPY to the market cap weighted SPY. And you can see when this is driving higher, that to me says that there's really good broad buying, broad strength among all 500 stocks, and actually the smaller ones are leading. When you have this decline, it means that it's a fewer number of stocks within the index that are driving the index higher, and there are more and more stocks that are kind of falling off. So you're getting this increasing dispersion under the surface, and we can see that in another ratio, this Russell 2000 to the Russell 1000 ratio. We can see this peaked June of last year and rolled over, which is a pretty decent warning signal that these, the push to new highs in the S&P 500 early last fall, was, maybe not sustainable with the Russell 2000, the weakness in the Russell 2000. But we've also seen that, since early this year, February, March, I think it was March when the Russell 2000 really started rolling over versus the Russell 1000, big cap stuff. And, this, goes back to a couple of things. It shows the increasing dispersion in the market, but it's also, as I mentioned, Stan Druckenmiller looks at this as almost an economic indicator as well. And so the weakness in the small cap names is, another red flag for this market. One other indicator that I like to look at in terms of breadth dispersion is the Hindenburg omen. And I think the Hindenburg omen's gotten a bad rap. Recently, people have kind of made fun of it as a false signal or worthless signal. I don't really put much stock into one signal. But when you get clusters of signals, it can mean something. And it usually does mean something important. And Hindenburg's only triggered when you have stocks at new highs or very close to new highs, and you have a growing number of both new highs within the index and new lows within the index. And so you have a bunch of new lows triggering at a time when a market's at a new high. So that is by definition the definition of dispersion under the surface. And so this chart here shows when you get this indicator at the top of the page here up to 3, that is a triggering of a Hindenburg omen. And you can see this is the New York Stock Exchange. Since mid-July, we had 7 Hindenburg's omens triggered in less than a month's time. And if you just look back over time, we click on this chart, and let's just go back 20 years, probably enough. And you can see when you have clusters here, you can see we had a couple of little clusters here at the 2000 top. That was in March, late 99, and then fall of 2000. We had some clusters. At the 2007 top, we had some back in 2006, and then 2007 we had 2 big clusters in the summer and fall of 2007. We had some clusters here in 2015, right before we had that the August 15 sell-off with the yuan depreciation, and then the early 2016 sell-off. We've had tons of clusters really since, leading into the 2018 peak here. Another way to view this is I like to run the number of Hindenburg omens triggered over the last 12 months. And so this chart, this is on my website, you can see at the 2000 top, we had just over 20 Hindenburg omens triggered into the fall of 2000. We had 37 or so, I think, at the 2007 peak. Last fall, we had over 50 Hindenburg omens triggered over the last 12 months. We're now back to 42 Hindenburg omens or something triggered over the last 12 months. And so to me, this is a very clear signal that we're having a lot of dispersion under the surface. So index is at new highs, but it's not being driven by a breadth of stocks within the market. So that's the way I view breadth, and you know, all these things are kind of saying the same message to me, which is we're seeing more and more stocks drop off out of the bull market that are falling into, you know, bear market type of territory. Another thing I like to look at is momentum, and I think the Copic guide or Copic curve can be very helpful here. It's a very simple indicator, was developed more as a buy signal, that when the indicator moves above zero, it's a sign that momentum is strong and it's safe to long-term signal to buy. We can see here that momentum has been waning through this, you know, like I call it a topping process. And we're very close to the zero line. A drop below zero would be a sell signal here. You can see the last few sell signals here in early 2001 and in early 2008 were decent, you know, signs that a bear market was underway. This was kind of proved to be a false signal from 2015-16. But another way that I look at momentum too is to come back to here. This function that StockCharts has, this is very, very handy, the past data function. I'll download the data into a spreadsheet, and then Michael Oliver is a friend of mine who's developed this momentum framework, and you can basically look at price relative to a moving average. And so this chart shows the whole bull market, and it shows the price of the S&P 500 relative to its 36-month moving average. So this would be demonstrating very long-term momentum. You can see momentum got really, really strong here in late 2010, early 2009. Very healthy sign that this was similar to a Copic guide buy signal, that this is a very strong push higher and was going to continue on. You took out, made a new high in momentum, and here in 2013-14, started to wane prior to this decline here, but we've made a lower high in momentum in early 2018, another lower high in late 2018, and then these new highs that we've made here this year are come on much lower highs in momentum. And so to me, this is the best visual representation of how strong is this market right now. Well, in the context of this long-term bull market, these new highs are coming on some of the weakest momentum we've seen during the entire bull market. And as my friend Michael Oliver, like I said, he's developed this momentum framework, says if you just draw a horizontal line here on the lows in momentum, this is a huge momentum structure that's lasted about, I don't know, almost 10 years now. And breaking below this, whatever it is, 4 or 5% where the support is, would represent a massive shift in this trend from bull trend to bear trend. And so that's something I'm paying close attention to. This waning momentum confirms the idea that this is a topping process, but the real bear market confirmation would come from a breakdown to a new low in momentum. Not necessarily a new low in price, but a new low in momentum. Another momentum signal that I like to look at, and if we have time, I can actually explain how this works. Every time I run these Demark sequential indicators on a chart, people say, hey, where is that in StockCharts? And so it's not on StockCharts. You can't get it on any charting platform except for, I think, Bloomberg, and you have to pay $1,000 a month extra or something for the indicators. But Tom Demark is a gentleman that I met a little over 10 years ago, introduced me to these exhaustion indicators that he developed. Tom is a brilliant guy who's worked for essentially whoever's run the biggest hedge fund on the planet. Tom has had Tom on staff for the past 30 years. So, but Demark sequential is something that I look at because it's an exhaustion indicator. And it's basically got two phases. There's a setup and then a countdown. In the setup, you essentially just need 9 closes in a row where the closing price is higher than the close 4 bars before it. So you can see here's the 1. I only labeled the 9 because here's the 1. This close is higher than 1, 2, 3, 4. So you have 1, 2, 3, 4, 5, 6, 7, 8, 9. Trust me, these are all higher than the closed 4 bars prior. So then you get the 9, and that completes the setup. Sell setup's complete. Once you get that, then you're looking for the 13, which would be basically you need a close that is higher than the high from 2 bars prior. So here would be the 1, because this close here is higher than that. So 1, 2, 3, 4. This one doesn't count. So these have to be sequential. If you have one bar that doesn't meet the criteria, then you don't have a sell setup. You have to have 9 in a row. These do not have to be sequential, so they don't have to be 9 in a row. We can have 1, 2, 3, 4, and then we have 5, 6, 7, 8, 9, 10, 11, 12, 13. So we had a daily Demark sequential sell signal back here in mid-July. When you look at the weekly chart, we had a weekly sell signal also in mid-July. I look at the monthly chart, we had a monthly sell signal back here in late 2017. And on this time frame, this was a pretty decent sell signal. Stocks have really gone nowhere since that sell signal. And we can even look at the quarterly time frame too, which is, I love that, StockCharts is one of the only platforms that allows me to run quarterly charts. And this is actually SPY, not the S&P 500 index. But when you have a very strong uptrend, Tom has said that sometimes you'll get a 9-13-9 sell signal. So you'll get a setup, a countdown, and then another setup afterwards. And that's essentially what we've had. If you go back to the very beginning of the bull market here in 2009, we had a sell setup complete in late 2011. We had the quarterly Demark sequential sell signal in early 2015. And that's when we had that late August 2015 sell-off, early 2016 sell-off. So that was a pretty decent indicator too. But on this time frame, you're really looking for a multi-quarter reversal. And then we had, after this, we had another sell setup complete. So you had a 9-13-9, which Thomas said is the most powerful sell signal that you can get. And since that time, stocks have gone nowhere. So to me, this is kind of also an exhaustion signal that's confirming the signal for momentum. And so aside from momentum, something else I like to look at, risk appetite. Risk appetite to me is maybe one of the most important things to pay attention to when investors are risk seeking. Stocks should do well. Junk bonds should do well. When investors are not risk seeking, they're more risk averse. And I'm not talking about like risk on, risk off. I'm talking about looking under the surface and seeing what types of stocks investors are embracing, what types of securities. And so we can see these ETFs only date back, to the mid 2000s, and so we can't look back at the 2000 top. But if you do look at this top panel here, this second panel from the top is essentially a replacement for spreads, corporate bond spreads. And so we have higher prices here on the top. This is the S&P 500. Then this is the corporate bond ETF relative to the same duration treasury bond ETF. And so when spreads are narrowing, and it's also, when spreads are narrowing, that's a sign of risk taking. Spreads are widening, that's risk aversion. And so when you have stock prices moving higher, but spreads widening, or investors preferring treasuries over corporates, that's a sign that investors aren't embracing risk the way they should. And so we saw this at the 2007 top. We saw this leading into that 15-16 sell-off, and we've seen it more recently over the last couple of years too. Even more, it's been more pronounced in junk bonds than in general corporate bonds, but we still see it here in corporate bonds as well. In this panel here, this is the SPY to the consumer staples ETF ratio. Investors should be embracing risk by buying SPY over staples, but this is basically just a shorthand version of another risk appetite type of indicator that I use. And so when investors are piling into consumer staples rather than into tech or consumer discretionary or what have you, it's a sign that they're risk averse. And so we could see divergences here where staples are outperforming. Staples have been outperforming dramatically since early mid 2018, which tells me that investors aren't embracing risk in the equity market the way that they should be. And then finally, this is also a risk appetite thing here too. This is basically just the VIX inverted. with the S&P 500. So the VIX, when stocks are making new highs, the VIX should be making new lows, right? It should not cost as much to buy protection against the S&P 500 when it's moving higher. People should be less inclined to buy protection, and so the VIX should be making new lows. But you can see at the 2007 top, prices were making new highs. VIX was not. VIX was actually making higher lows. And like I said, this is an inverted chart. So this tells me that investors were keenly buying put option protection, more so than they should be when prices are making new highs. Same thing in 15, 16, and same thing recently. The VIX made its most recent low in late 17, hasn't made a new low since, even though price made a new high in 18, again in summer of 18, and this year, VIX has been making higher lows. This tells me that there's a lot of put buying going on. That's a lot of risk aversion. That's just not healthy for the broad market.
Hey, Jesse.
Yeah.
Question that kind of general question, I guess. Obviously you're looking at the market and appear to be, pretty bearish based on all the support and arguments that you've provided here. How are you trading the market? I mean, are you looking just only on the long side at defensive areas of the market? Are you shorting? How are you trading the market right now?
Yeah, thank you for the lead in. That was exactly what I was getting to right now, Tom. I'm almost always long short. And so I'm long certain things that I think are attractive. I'm shorting things that I think, and generally right now, a lot of my shorting is focused on the broad indexes. So I'll short SPY, QQQ, IWM against my longs just as a hedge. And so, but I think generally for most people, reducing your exposure to equities during a time like this makes perfect sense to whatever extent you're able to. And for some people, if you have equity exposure, you don't want to take capital gains or whatnot. You can go to my site. I wrote this post right here. Worried about a stock market crash? Here's how you can tail hedge your portfolio. It's a very simple tail hedging strategy developed by Mark Spitznagel that he wrote about in his book, The Tao of Capital. So it's a very simple put buying strategy. But what I'm doing more specifically is I think investors should focus on value. This is essentially the ratio of value to growth. And to me, this looks very, one of my favorite chart patterns is this kind of ending diagonal or bullish wedge pattern. And to me, it looks like value is forming a bullish wedge right now, longer term. And I'm watching this chart weekly to see when this thing's going to break above this downtrend line here, because once it does, I think there's going to be a very interesting shit. And this also really reminds me of 2000. If you look back, there were, it was the NASDAQ and the dot-com stocks that were driving the market. But there were a number of stocks that were absolutely left for dead, value stocks back then. It's not as dramatic today. I think the market is more broadly overvalued today than it was back then. But there were stocks like Ball Corp. This was a stock that I bought back in 2000. I sold it way too soon. But Bill Stieritz was the CEO. It was the CEO of Ralston Purina before this. He came in, he put in his whole management team, and he bought something like $40-50 million worth of stock with his own money. And all of his top executives essentially put close to their 100% of their net worth into the stock with open market purchases. And the stock's up from $2 to $80. It's up 40-fold since then. So there's opportunities like this in value names. I think today in the market today, and this long term, and we could go back even further with this thing, and you can see value's been dramatically underperforming for this entire bull market. It's actually one of the worst drawdowns for value in history. And so I think there's a terrific opportunity today to focus on value. One of my favorite ways to do that too is rather than use a market cap weighted index, there are the fundamental indexes that are created by research affiliates. I think Schwab has a couple of ETFs where they're not weighted by market cap, they're weighted by sales, they're weighted by book value, they're weighted by these types of things. And it's basically a way to just limit your exposure to overvalued stocks today and put a little value tilt on your portfolio if you're using ETFs.
Okay, that's awesome. Well, it's always a great, a great pleasure having you on the show. You gave everybody a lot of food for thought from a bearish perspective, and it's always good to look at markets from, different angles. So we certainly appreciate you taking the time out and joining us here on Market Watchers Live.
Thanks for having me on, guys. I'm a big fan of what you guys do, and I appreciate the opportunity.